And due to 50 years of siloed COMEX price suppression, silver, as we know, is the most undervalued commodity on this planet Earth.
Andrew, that's amazing. I know that I'm not speaking for myself here, but I got to ask you this question because we've got a lot of silver fans. We've got a lot of silver stackers and accumulators that watch this show every single time it comes out. Can you just talk about what is going on with silver?
Shane, I always know the silver question's coming, and I know the big smile I see on your face when we, I mean, I know you've got silver all around you. Usually at this point, you pick up silver coins around you because you just love them being around you. But I think, yeah, while the larger gold market, it's important to understand that while the larger gold market is undoubtedly the focus of this war, the smaller silver market is easy to read, and it really acts as a really fair proxy as to what these same actors are doing in gold. In fact, while officials are not assessed to have any skin in the silver game, actually, in fact, they do, in so much as the too big to fail banks are holding substantial naked short over-the-counter silver derivative bets, which, if you want to identify them, they're in the quarterly OCC Office of the Comptroller report. So that's right there and then. And even if you discount, the 20% that's palladium, platinum, I mean, you're still talking, it's a multi-billion-dollar bet. And these accrued multi-billion-dollar over-the-counter derivative bets have recently been exposed to the Russian commodity market blowback and throwing their long-standing undeliverable bets into the crosshairs for potential physical delivery. And at best assessment, these short silver bets, which have accrued over time, have a break-even point of about $23 an ounce. But as we discussed in a recent liquidity provider meeting, asking this question, would the bearish derivative bets have been instigated following the March Russian sanction blowbacks, drastically tightened available supply, backing up these bets? Clearly, the answer would be no, resounding no, and all commodity prices will rise. And due to 50 years of siloed COMEX price suppression, silver, as we know, is the most undervalued commodity on this planet Earth, bar none. And the nickel blow-up triggered the exit of JP Morgan and others making markets in base metals. But as we reported back 4 episodes ago, back in March, we've got direct first-year bank information that these banks also want to square up and receive back their silver lease positions before silver does go nickel. Now, you're seeing a panic to do that. And we're not the only wholesale participant that assesses that the CME bailout of the 10 times larger than related COMEX over-the-counter derivative bets on the 18th of April. This was a coordinated official bailout of both the lessors and the lessees of this multi-billion-dollar derivative position, which had once again crossed the Rubicon line, which we talk about consistently, which is 26,225. That is the line where these bets blow up. And in reality, we've seen the desperate attempts to do this. They've connected the ES and SI algos. They've captured SI, the silver futures, that is. This ridiculous algo. There's no place for this algo to be in place. But you get enough people that believe in it, and the HFTs control it, and all the smaller algos join in. And again, you've got a connection. And as we discussed in our last episode, this is coordinated with the rescue of this multi-billion-dollar over-the-counter OCC naked short, too big to fail bank bet that was implemented on April the 18th by way of an unprecedented, this is the CME Bailout, this is an unprecedented, officially sanctioned bailout. Where in a million years have you ever in the history of the COMEX or the CME seen a margin reduction into a price rise? I mean, that's ludicrous. That is ludicrous. And it's so blatantly, obviously, officially sanctioned. And obviously, this was put in to rescue the too big to fail silver actors from the break point of these multi-billion-dollar underwater bets at 26.225. In fact, it had just gone beyond that level. And suddenly the CME margin reductions come in, i.e. Providing credit to the shorts. Now, the extent of short covering afforded by this rig sell-off is opaque and pretty much, look, it's yet unknown, but a general assessment by liquidity providers we've talked to say it is significant. And any remaining COMEX-related open interest is now solidly embedded and largely unflushable. So it's assessed that the level of selling that occurred below $23, this is their break-even point, is 100% spec short selling with these same insiders one-to-one long against them, which now presents a very attractive additional short covering layers above the market into deeply technically oversold conditions. So you've kind of got the casino. Now, you know, they all run on a 5 to 95% ratio where the house wins 95% of the time, but the house has got to win 5, otherwise they run away. Well, you've reached that point. COMEX sellers are still adding supply into this backwardated condition. However, what's not yet evident to COMEX short sellers is that the historical COMEX silver relationship with this 10 times larger spot market became actionally inverted. Now, if you're a trader, you will know how important this is, because whereas COMEX shorts traditionally hedge these over-the-counter longs, the spot longs that we talked about in gold, but it's the same in silver, they basically ran at around about a 17 to 20 cent contango, i.e. they traded about 17 to 20 cents above spot silver. So that provided a mechanism to actually play a game. Now, into the sell-off last week, though, below 22 and below 21, the oversold paper market condition inverted into a technical 10-cent spot premium to futures. Now think about it. That's like 10 plus the 17 to 20. That is a major inversion. So what does this mean? It was the perfect setup for the house to lay the short liability off onto the blinkered specs, as insiders could then hedge naked short COMEX positions in the 10 times larger spot over-the-counter market, inverting the entire trade. Now, good God, this is a bullish setup with insiders getting as net long as possible and the OCC short over-the-counter bets receiving a bailout to boot. This is so coordinated. Now, the silver market, bottom line, it's broken in so much as price action in silver only represents derivative market action. However, even when discounting supply-demand dislocations, remove them altogether. When a paper market is this technically oversold, just a dot on a screen, if there was no physical imbalance, forget that. The nature of any paper market is to retrace oversold technical conditions, and this brings the spec short stops placed above each of the full set of moving averages into the crosshairs. So with commodity markets tightening, liquidity providers assess that the next run at the Rubicon line likely succeeds. Have you got physical? Is my only question.